Maverick traders, welcome back to your market roundup. It's April 28th. Corey here with you, back from the summit, and we had an amazing time. We'll touch on that a little bit more throughout the video. As always, we're going to take you through meaningful news. We're going to talk about what sectors are heating up, which ones are cooling off, and then always highlight our very best trade ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
So as we take a look at the markets, it was really a quiet entry, not a big gap or anything like that from the weekend. Dow, S&P, NASDAQ, Russell, all relatively flat. Commodities were moving, gold up 1.8, oil down 1.8. Now you'd really like to see that flip-flopped if you're cheering on the bullish market environment and an upward push, because oil tends to be more economically sensitive and gold tends to be more defensive. So today, from that standpoint, was kind of a negative, a risk-off day. Now, as we look at daily news, big tech earnings arrive this week and next week, and we're going to hear from a lot of big tech companies over the next couple of weeks. The Apples, the Googles, the Microsofts of the world, and we know that they play a big role in where the S&P 500 goes. Oil sharply lower, again, kind of a weaker read on the economy perhaps, and then maybe we're in a little bit of an ABC correction in the S&P. We'll talk through that. Advanced decline line, about 2/3 of stocks advanced today, and the 50-period moving average is the opposite, about 2/3 of stocks still in a downward trend, but we definitely have seen some improvement there. We have seen some improvement in terms of the numbers, but still more of a bear market with 2/3 of stocks trending lower. The S&P 500 has arrived back up to the old support zone. Now, a week or two ago, I talked about, I think it was when we were kind of in here, that it was my expectation that we would push above that resistance zone, that we would kind of fake out to a certain extent. And I always say that support and resistance is more of a zone than an exact price. I think of it like a trampoline, that when you land on a trampoline, it gives and then it propels, right? So this resistance will probably push up into it a little bit, and then it very well might propel us lower. So this push into and then the reversal. Now, why does it do that? Well, does it probably because there's stop losses up there to trigger the short sellers to cover, to suck in buyers, to whatever. And basically that would be the end of this current push higher, and subsequent decline would be expected. If we look at the NASDAQ, really the same mental picture. We're pushing up into that zone, maybe just above it, and then we get the reversal. And on both of these charts for the Elliott wave technicians, you can see that it's a normal style of correction, what we would call an A, B, C correction. So in a bull market, you go trend up, and then corrections would be what? Well, of the A, B, C variety would be pointed to the downside. And then we go back into the uptrend, right? In a bear market, you get the motive waves and the overall trend is falling in this direction, and then you get the ABC back up. But the ABC is not enough to recover all of the prior declines. It encounters overhead supply, willing sellers up here that keep a cap and a lid on the upside, and we ultimately reverse to the downside. So that's still my base expectation for the markets. If we take a look at gold, let me back up one step. If you look at where the market bottomed, see the big volume and the huge candles down there, obviously a big exhaustion, kind of panicky low. Well, on the flip side of that is the gold chart, and gold had a panicky high. What do I mean by that? Big volume, bigger size candles, big reversals, big gaps, and all the telltale signs of kind of an exhaustion and exuberance that got too far too fast. So just as the market bottomed on that type of exhaustion behavior, gold was probably in the news as, oh, it's fantastic, get in before it's too late. And the fear, the FOMO, fear of missing out, caused people to pile in, cause those gaps and so forth. And that's when the run has stalled. Wouldn't surprise me if gold went through its own sort of ABC. But is gold still in a bull market? Yes, gold looks so much better than other things. It's just that things need to correct. Things need a breather. All prices have to go through corrective shakeout type of phases when you've been on an absolute heater like gold has been in. So this is pretty normal behavior. Don't be surprised if there's another little leg lower in gold, but ultimately it will probably resume its upward trend upwards to new highs. Just needs a little bit of a rest. When you're tired, when you're exhausted, when you've been running a lot, you need a breather. And that's kind of where the gold chart looks to be for us. Now, as we look at other price action across various entities, you can see NVIDIA weak today. Some pockets of strength there, AbbVie and Gilead on the stronger side, Colgate over here weaker, but for the most part, just really a quiet day, more of a sideways day, not that much in the green or in the red. It was just a little bit more mild across the board. Let's look at some charts of interest. I'm not as inclined to get super bullish right here, right now. I think the bears look better from the standpoint of a quick trigger, a more opportunistic trade in the near term. But let's look at a couple of these bullish charts. So Palantir, if I were to look at this chart, I would say, okay, maybe a pullback back to the breakout zone and then the upside, right? Something along those lines, which fits in the context of the big pattern that I think it's forming, which is a big cup, a big bottoming out, big saucer, whatever you want to call it. Might it do a big cup and then a handle somewhere down here? Sure. But first, we're in the big cup. So I'm not inclined to chase Palantir, but if it gives a nice little pullback back here somewhere and then pivots upward, it would be of interest to me. So Palantir on the long side. Uber, I'm going to give this a characteristic that's similar to Palantir, maybe a cup and handle type of pattern. I really like Uber much more in the dip, in the pullback back into this, call it 75-ish zone, and then for a possible trade to the upside. As I've said, most of the bulls don't look like great trigger points right here, whereas the bears do. So look at CSX chart. You can see the trend line here, and it's really sort of a symmetrical trend, right? A symmetrical triangle. A symmetrical triangle is also often called a volatility compression. The idea is that volatility is just getting squeezed tighter and tighter. It's basically a lack of volatility trade, that this price hasn't gone anywhere for multiple weeks. Lower series of highs and a higher series of lows, and you come to the point of the triangle where you have to resolve. Now, if it breaks higher, I'm not really interested. Why? If it breaks higher, it comes into all this overhead resistance, and I'm just not sure it could really take off in any meaningful way. But if it breaks lower out of this symmetrical triangle, it would not take much to take out the lows, to go make new lows, and to continue on this downward trajectory. So CSX on the bear side, and Pepsi also looks like more of a bearish candidate. You can see, well, frankly, this is sort of like the CSX chart back here. You see the little volatility compression and then the breakdown, and away we go. Pepsi, you might have missed the initial breakout, but there could be little pullbacks or maybe a low base forming here and further deterioration. Pepsi has relative weakness compared to its sector, compared to the market as a whole, and just some nice downward momentum to it. So could be a possible candidate as well. From a market perspective, leaning more towards that we're in an ABC style correction. I believe that the dominant trend. My base case expectation is that we're in a bear market and you get these ABC corrections, which are fake outs, they're shakeouts. The opportunity is out coming out of them. There's likely a resumption of the major trend, which in this case would be lower. We've got non-farm payrolls on Friday and then earnings tomorrow. We've got booking, this price line is what they used to be called, Honeywell, Coca-Cola, Visa, certainly Coca-Cola and Pepsi tend to trade similar to each other as major competitors, and stylistically the companies are very similar. But those are just earnings for tomorrow. There's a lot more companies across a variety of different sectors, and again, large cap tech coming. So we've got plenty to on tap to create some volatility here in the not too distant future. I think a little bit of a calm before the next storm is what we're in. For those of you that joined us in Las Vegas, it was amazing. The event couldn't have gone better. Feedback was phenomenal and so great to put a face to the name and to get to know so many of you better. For those that couldn't join us, we missed you. Hope to see you at the next one. But it's always fun to just get together and talk to people that have similar interests. Hope everyone travel back safe, and we will see you next time. Have a great week, everyone. Till next time, goodbye.